Michael Ruscetta joins me now. He's the CEO of Trichome Financial Corp. Michael, welcome.
Thanks for having me.
Yeah, you bet. Michael, quick overview. What does Trichome Financial Corp do?
Sure. Trichome Financial is a specialty finance company focused on the cannabis sector. We provide tailored credit solutions to the industry, really addressing a lack of credit that we've seen, seeing it play out in real time today.
Based in Canada or the U.S.?
We're based in Canada, right here in Toronto. We're currently lending to Canadian companies and global companies, and we expect to be lending into the U.S. probably by year end.
Okay, great.
Yeah.
Probably a good example of a transaction is your recent $4 million loan to James E. Wagner.
Correct.
So I guess the benefit of a debt facility in this market is when things go soft and people can't access equity capital, there's a debt option.
Sure. And look, there's we've been involved with James Wagner now since February. So this is an additional draw. And the nice thing about our business is that we like to grow with the companies that we finance.
Right.
And so you're right, the equity markets are challenging, and they're a more mature sort of business relative to many others. So as a lender, we can actually look at it and evaluate it from a lender's perspective.
Okay.
And we do a very extensive due diligence process and understanding their financial needs. And oftentimes equity markets are sort of focused on near-term headlines and noise and things like that. We try and sort of see through that.
Sure.
Yeah.
Okay, so is for example, let's talk about the $4 million loan to James E. Wagner. What was the interest rate, the coupon for that?
So the coupon on that is 9.25%.
And is it secured?
It is secured.
Is it convertible?
It is not convertible. We don't typically do convertible loans.
Okay.
We don't like that structure. We're not a hedge fund.
Right.
So we don't take short positions against our loans. We will have equity warrant coverage as we do in this transaction, but we're not looking to short a stock and protect ourselves. We do an extensive amount of work, and we're taking a fundamental view.
Okay, 9 is within the realm of comfort, I would think, for most companies. Some lenders we've seen opportunistically sort of entering the space and extending high interest loans that are, covered a exponential amount greater than the face value of the loan. So you're not that type of opportunistic lender, is what I'm understanding.
No, I mean, look, we have a cost of capital, and we price things fairly in the context of the market. We would much rather see companies do well, and therefore we'll do well with them. So, we can, reasonable people can debate what's expensive and what's not expensive, and that's fine. But we don't want to be viewed as anyone that's trying to take advantage of these companies.
Okay, not a loan-to-own operation.
Absolutely not.
Okay,
No,
great.
No.
What is the typical size of the loan that you prefer to extend?
So right now, the opportunities we've been reviewing are sort of in the $5 to $20 million range. As our business grows and we have more capital, we'll be able to do larger transactions. We have an extensive group of syndicate partners that we can reach out to. And if there's a transaction that is above our comfort level, size-wise, we can go out and syndicate our transactions. So that's part of being in the business, much like what banks typically do is they syndicate their risk.
So is the ecosystem place that you prefer to lend to focused on licensed producers only, or do you extend out to picks and shovels, media, et cetera?
Yeah, absolutely. Across the value chain. So we had a very successful loan to a Ontario retail lottery winner back in March. Ganjica House in Brampton has done very, very well. We provided inventory financing so he could put product on the shelves, as well as enabled him to fit out his store. The store has done extremely well, He's actually repaid our entire loan, and we have a warrant to acquire 10% of that store for the next 4.5 years. So we've looked at technology companies, we've looked at processors, hemp producers across the value chain.
And what is the size of the loan book now in total?
So today we have outstanding loans and commitments of about $11.5 million. We have signed term sheets for another, call it $10 million. We're very busy right now. So
Right.
yeah, our work in process, the stuff that's not signed, but it's probably close to getting signed,
Sure.
is multiples of that.
Okay, and so is your target rate of return something that you're open to discussing?
Look, we don't typically discuss it. Broadly speaking, every transaction brings its own unique challenges.
Sure.
We typically tell companies that we're looking to solve for a contractual rate of return, which is interest and fees and things like that in the low to mid-teens. And in many cases, there's additional warrant consideration.
Sure.
And so, that may juice it a little bit, may juice it a lot. There doesn't always have to be equity consideration. It just
Right.
really depends on how we want to address the particular issue at hand.
So, but the target rate of return is roughly in the teens.
In the teens, yeah.
Okay, well that makes it an interesting value proposition for investors who want exposure to the space without the risk of actually
Right.
picking one name.
Right.
Is that the sort of investor value proposition that you're projecting?
It is. So, I mean, the way I think about it from an investor standpoint is, we're exposed to the secular growth of this industry on a long-term basis. So we are a growth company first and foremost, but our business model is much more defensive. And so that's a pretty unique combination. So for some people, they may want exposure, but they don't, they've seen what's been happening and they don't want to really take big risks.
Right.
Or they want a more diversified portfolio of that risk. And considering we have secured loans, we're first in line in case anything happens. So, our goal is to provide our investors with attractive returns on equity that, quite frankly, most folks would love to have on a long-term basis.
Sure.
Plus, the other aspect of our business is, we're really a platform opportunity. And so we're in the process of launching a fund management business where we'll manage third-party capital for a fee. And so going forward, we'll be this hybrid business where we'll have our own capital that we'll be lending out, but then also earning fees on externally funds managed.
That's very interesting. So does the advent of a price war in cannabis, I'll use Canada as the example. In the States, it's 50 different countries
Sure.
for all of that concern. But in Canada, we've had one LP, Hexo, step up and say, okay, we're coming out with this product that matches the price point of black market product. I was actually spent the weekend reading reviews on their product, and it's uniformly considered very good.
Right.
Does that sort of concern you at all as somebody who analyzes the revenue that companies generate and their ability to repay their loans?
100%, it does. We, in any company, any LP that we look at, we're usually modeling significantly lower prices than the market is even contemplating. So our conservatism is already baked in. The other thing I'd say is, on the LP side, we tend to focus on companies such as James Wagner or Good Buds, which is a private company, that are sort of niche, small batch, and are doing a premium product. And so we think that's a much more defensible part of the market. If you are a scale producer, you have to be very efficient at doing it. And many of these companies, as we've seen, have, quite frankly, bloated cost structures.
Right.
So we prefer to look at the smaller batch premium producers as opposed to just a run-of-the-mill LP that's producing a run-of-the-mill product.
Right. Interesting and good approach. How does the landscape for lending to cannabis companies look to you from where you sit as a sort of specialty lender with the, you've got the BMOs and the CIBCs stepping in to that spot, and is that kind of like not of concern because they're doing a completely different scale of business, or are they somebody you might partner with?
Yeah, I mean, our business was never premised on competing with banks. We all know that's kind of a mug's game. But what we saw is, there's only so much the banks are prepared to do, both from a risk perspective as well as from an industry perspective. So we think that, as this industry unfolds over the next, 10 years, the credit market opportunity is in the tens and tens of billions of dollars, right? And what we've seen since the crisis in 2008 is non-bank lenders are a much, much larger share of the lending market. And that's really how we position ourselves. So we'd be happy to work with any of the banks. In fact, we do work with one in particular, where we work on transactions together. And so there's a role for us. We fit hand in glove,
right?
Because we can take a different risk profile than the banks can take.
Sure.
The other thing I'd say is we've heard that bank risk officers are becoming increasingly skittish, considering what's gone on in the market. And any pause in that lending, we see that, and our phone's been ringing a lot. It's like, oh, we were speaking to so-and-so.
Sure. I guess for me, pricing in the future of the various extracted and concentrates and derivative products from the cannabis itself becomes very challenging, considering the presence of the black market. I mean, the question really becomes how much price sensitivity does a black market have to continuity of operations over time relative to LPs who are reliant on equity capital and or debt capital?
Sure. Well, I mean, look, the black market's done a very good job over the last, hundreds of years.
Yeah.
So I'm sure they know a thing or two about surviving. And look, the issues driving the sector today, I mean, we expect that Ontario will liberalize its retail system in the near term, sometime in 2020. There has to be market access. If there's not market access, then there's a problem. Right. And I think collectively, regulators and governments, regardless of political stripe, are recognizing it's here to stay. So we might as well make sure that it's working efficiently. And it hasn't been working efficiently to date, but it is what it is. It's 1 year in.
Yep, you bet. All right, Michael, that's a great introduction to the company. I look forward to following your progress. I look forward to recommending you to clients who I think would be worthy if you haven't already talked to them. But anyways, thanks very much for joining me.
Thanks very much.
Only one, two.